Welcome to the Daily Fiscal Pulse for the 18th of June, 2026. We're looking at Thursday's session here, and everything you're about to hear is based on settled numbers, not real-time data. Let's start with what's moving the broader market conversation. The Iran and Middle East situation is the dominant narrative right now. The Treasury Department's authorization of Iranian oil sales through August is shaping price action significantly. That said, market flows tend to be more transparent than headlines. Narratives can shift quickly, but the money tells a clearer story. Turning to the fiscal numbers now, we saw a net transfer of $9.0 billion printed today. On the surface, that looks manageable. What's more telling is the directional shift. The 5-day average has dropped to roughly half of what we've been tracking in recent weeks. Tax receipts are doing the heavy lifting at $13.2 billion. The S&P 500 futures are telling a somewhat different story than the flow data would suggest. ES closed at 7,556, maintaining a position above its 20-day moving average of 7,505. The 20-day trading range covers approximately 385 points. The index is holding steady even as the fiscal environment headwinds are increasing. Looking beyond today's action, the longer-term pattern is what really matters. Government spending over the last 5 days is averaging $21.2 billion daily. Now compare that to the 20-day average of $4.0 billion. There's a clear deceleration here. Essentially, less cash is flowing through the system, which means less liquidity reaching households and filtering into markets. That's tightening financial conditions. The year-over-year comparison reinforces this. Through the fiscal year to date, spending stands at $1,032.7 billion, representing roughly a 5% decline versus the same period a year ago. That's a substantial reduction in fiscal support, and it has real implications for system-wide liquidity. Anyone considering adding risk exposure needs to account for this fiscal headwind. The current environment isn't offering tailwinds to equity valuations. Our conditions gauge is registering -51. But history provides some perspective here. We've navigated similar setups numerous times, and despite tighter liquidity conditions, the S&P has averaged approximately plus 1.6% over the subsequent month. Markets and liquidity don't move in lockstep. They can grind higher even when cash flows slow. One thing worth watching is where leveraged funds stand. They've been trimming positions while margin debt is hovering at the 100th percentile. That's an elevated reading, and historically, these levels function more as a caution than a signal to buy. Here's the risk asymmetry. Fiscal flows running below last year's pace mean the system has less of a cushion. When favorable news hits, stocks can still move higher in a grinding fashion. But if a risk event materializes, such as escalation in the Iran or Middle East conflict, downside moves can accelerate quickly. There's simply less liquidity underneath to absorb the selling. Looking ahead, the 24th of June brings the SSA payment cycle. That's the fourth Wednesday of the month, and it can meaningfully alter short-term flow patterns. Fiscal headwinds are clearly embedded in today's data. The deceleration may be stabilizing though. What happens next probably hinges on how these upcoming scheduled flows actually land. That sets the stage for the next trading session.